You don't often have a chance to invest in a company that is literally the best in a certain category of all public companies in the world. Mercado Libre is that company. Out of over 80,000 companies, it is the only one that managed to grow by more than 30% for 27 consecutive quarters. That's almost 7 years.
That type of growth is just utterly ridiculous. But the best part is that there's still a lot of room for growth still. E-commerce penetration in Latin America is only 14%. That is much, much lower than other parts of the world, which means there's just more opportunity to grow.
And while MELI isn't obviously cheap, it is trading at its lowest valuation ever, so it's a good time for us to look into it.
In the past, we have covered Amazon, the most valuable e-commerce company in the world. Before that, we talked about Coupang, often called the Amazon of South Korea, and Alibaba, which people love to refer to as the Amazon of China. So if you're mentally drawing a map of the world right now, there is one major region we have not talked about yet, Latin America. And of course, Latin America has its own version of Amazon. That company is Mercado Libre, and that is the business Daniel is pitching today. And so what makes Mercado Libre so remarkable is if you just pull up any of its financials, you'll see incredible, incredible growth. And I mean, the numbers are they're honestly breathtaking. Mercado Libre is the only publicly traded company to have delivered more than 30% year-over-year revenue growth for 27 consecutive quarters. And while that might make it sound like we're late to the story here, this is a company that's still growing at about 30% today. And when you look at how under-penetrated e-commerce still is in Latin America, you could probably argue that we're still early in the company's opportunities. And so I'm already starting to paint a bit of a bullish picture here. I should just give a quick disclosure that nothing on this show is meant to be taken as financial advice. As always, everything we discuss is for educational and entertainment purposes only. And while we're getting some of the red tape out of the way, let me go ahead and also say that we'll soon be welcoming our fourth cohort of members into the intrinsic value community, which we've been building over this past year alongside this podcast. And so admission to the group is based on an application, an interview process, and once accepted, members get access to an exclusive group of sophisticated investors. So that includes dedicated discussion forums for stock ideas, weekly virtual calls on really a variety of investing topics, and sessions with expert guest speakers like Adam Cecil and William Green. And beyond that, membership also includes access to private in-person events like dinners hosted by the Investors Podcast Network in Omaha during Berkshire Weekend. So if you are listening to this podcast, that means you are invited to apply to the community, and we would love to consider your application. So with that, though, let's actually get into your pick here, Daniel. Tell us about Mercado Libre.
Well, Mercado Libre was actually a recommendation that came directly from our community. So some members managed to get into the stock at even better prices than today's, although the share price hasn't moved nearly as much as the fundamentals would suggest. And technically, it is the cheapest ever right now, because over the last 5 years, revenue has increased more than sixfold, and operating profit has actually gone from roughly $100 million to about $3.1 billion, which is, and you can do the math by yourself, a 30 times increase. And over the same period, the stock is up only about 30%, not per year, 30% in total. And part of that disconnect, obviously, is easy to explain because just like every other tech stock in 2021, the valuation back then was simply too extreme. And despite massive growth, it took MELI a couple of years to actually grow into it. And what really is interesting to me about this case is the opportunity of growth ahead in the next decade. The Latin American e-commerce market is expected to grow at around 11% per year over the entire next decade, expanding from about $1.5 trillion today to more than $3.2 trillion in 2035. And that growth is still being driven primarily by adoption. E-commerce penetration in Latin America is only around 14 to 15%. The US is at roughly 25%. The UK is close to 30%. And well, China is well above them all at over 30%. And I can't think of a good reason, and trust me, I have given this some thought, why Latin America shouldn't move meaningfully closer to those levels in the years ahead. And to make all of this Even more interesting, as I teased before, Mercado Libre is currently trading at its lowest valuation ever on an enterprise value to EBIT basis, which just takes the company's market value adjusted for cash and debt, aka the enterprise value, and then compares it to the operating profits of the business, where EBIT is an acronym that stands for earnings before interest and taxes. And that multiple sits at roughly 30 times today. And on the surface, that doesn't sound cheap. It doesn't scream cheap when you look at it. But when you put it into the context of the company and the growth it is still achieving, as Shawn said, 30%, and it also continues to expand its profit base, so we're talking about margin expansion, then it looks meaningfully cheaper than most businesses that you can call comparables to this company, especially if you look at the growth profiles. So the real question for today's episode isn't whether the multiple looks low in isolation, it's whether Mercado Libre can sustain this level of growth and then just gradually become an even more profitable company over time.
So I'm really excited to get into this one. This is one that our colleague Clay Fink has really been excited to talk to us about. And we've had a lot of requests from the audience to dig into Mercado Libre. So, I mean, this is going to be, I think, a fascinating company, and we'll dig into the numbers more and the valuation, obviously, as we do in every episode. But maybe just to take a step back, how about we kind of set the stage with the business fundamentals itself and just the history, as we often like to do. And so it's very easy, as we've been doing, to call Mercado Libre the Amazon of Latin America and feel like you immediately understand what the company is all about. But as we have seen with Amazon, that shortcut can be misleading because Amazon itself is not just a retailer, and it hasn't been just a retailer for a very long time now. Most of the profits from Amazon actually come from cloud computing with AWS. And every once in a while, they're doing things like launching rocket ships into space too. So Amazon is quite the diverse business these days. And so when we talk about Mercado Libre kind of mirroring Amazon, what part of that does so? And where does the analogy hold and where does it break down?
Well, Mercado Libre is definitely not shooting anything into space, and it also doesn't have an AWS equivalent. So we're not talking about any cloud businesses today. And given how important AWS is or has become for Amazon's overall profitability, that might sound a bit less exciting at first, but Mercado Libre is also not using its marketplace as a loss leader, which is what Amazon does to a large extent. And as we will see, it has some other, in my opinion, highly valuable business units that make up for the lack of a cloud business. And the company generally consists of course, its core e-commerce marketplace, then a fintech business that has really become one of its most important drivers of growth, and then also a large and increasingly sophisticated logistics network, which in that sense probably makes it similar to Amazon. And one of the reasons Mercado Libre is more profitable than Amazon's marketplace is the product mix. So over 90% of its gross merchandise value comes from third-party products. So merchants who list their products on Mercado Libre, that's a high margin business, obviously, because you don't have any inventory, you don't gotta buy products and then sell them, and you basically only get the difference between the price that you bought for them and the price that you sell them for. Instead, you just take a fee. And that fee is basically set. It's the take rate that you have, and it's about 20% for a company like Mercado Libre. Amazon, on the other hand, is mixing first and third party products a bit differently. They have about 50-50 mix between third and first party products. So Amazon sells a lot more products themselves, which tends to be a low margin business for the company.
Well, why does Amazon do that if it lowers the margin of the business? I mean, why go to first party and not just only sell third party?
Yeah, well, first party products generally give you more control. So you know about the quality of the product that you're putting out there, which can obviously increase the trust that people have in you when they buy on Amazon. You can also dictate pricing because competitors on the platform basically have to match your pricing. Otherwise, customers just wouldn't buy your product. And if you do that and you set the price low enough, competitors come in, and who benefits in the end is the customer. So they end up paying the lowest prices. And that's obviously one of the big value adds that Amazon offers to the customer: fast shipping and the best prices that you can get. And you can start new categories as well. So basically you say, okay, well, there's a product that we currently do not offer. So we're getting a product ourselves, and then we kind of create that marketplace. So let's say I want some niche football gear. If I can't find it on Amazon, I have to go somewhere else. And I might think, well, Amazon doesn't seem to have everything I need. So maybe next time I start my shopping process on Google immediately, or maybe in today's age on LLMs. So basically, to keep you in the ecosystem, it makes sense for Amazon to offer those products themselves, even if it's not the most profitable product that they could sell. And by the way, since we will naturally bring up Mercado Libre's name quite often today, it might make sense for me to just call it MELI, which is like the ticker, MELI, because I guess that will save us a lot of time and it will spare Spanish-speaking listeners the torture of my pronunciation. So yeah, talking about the history, MELI was founded in 1999 by Marcos Galperin, along with two co-founders. And Galperin is one of those guys who studied when they first started the company. He was at Stanford doing his MBA. A difference between him and a lot of the founders that we looked at on this show is that he actually finished his studies. So he finished studying at Stanford and then he went back to Argentina in about 1999 where he wanted to start his own company. And back then, as you can imagine, we're talking about the dot-com bubble here, becoming the eBay of X or the Amazon of Y was basically the default ambition in tech. Every single pitch deck that you will see from that time had some version of that story. And most of those founders were, in hindsight, obviously wildly optimistic, but Galperin and his co-founders believed they could actually pull it off and build the eBay of Latin America.
And ironically, that sounds a whole lot like Coupang, which we were saying people describe as the Amazon of South Korea. They were originally inspired by eBay, not Amazon, too.
It's hard to imagine today, but back then, it wasn't that obvious which of the two models, so either eBay's auction model or Amazon's fixed price model, would actually and ultimately win the e-commerce race. And for a long time, eBay was actually the bigger player. So in its early years, MELI followed that same path and focused mostly on auctions rather than these fixed price listings. And in other words, MELI initially acted as a simple intermediary. So they were matching buyers and sellers of mostly used goods, and then they would just take a small fee of the price you end up paying. And as far as I know, it is still known for that model in some of these smaller markets that it operates in. As you know, I was in the Dominican Republic a couple of months ago, and I realized there that a lot of people use it like Craigslist, basically. So a marketplace with private sellers and buyers, but not very similar to what Amazon does. And if you look back over MELI's history, you actually realize that it wasn't the company that ever pioneered entirely new products or even business models. It's a good example of a second mover that won simply because it was better at executing and problem solving than most of the first movers in those markets. And one of the biggest problems with operating an e-commerce store in Latin America at the time was just the lack of infrastructure that enabled US internet companies to scale. So we are talking about online payments that were barely available at the time, credit card penetration was low, and also the trust between the buyers and the sellers was just extremely limited. And an early milestone to fix those problems was a strategic partnership that MELI had with eBay, which just helped legitimize Mercado Libre as a marketplace in the eyes of actually both consumers and investors. And despite that relationship, management made an important decision to move away from these auction models to fixed price listings, especially in their biggest markets, which are Brazil, Mexico, and Argentina. And by the mid-2000s already, fixed price transactions accounted for the majority of GMV on the platform. And that was honestly just the first of many major strategic pivots that MELI did in its history. And it's a pattern you see again and again. The company hasn't really won the markets that they have by inventing either new categories or products or business models, but really by making the right choices at the right time.
And one of those decisions was also to invest heavily in infrastructure, I think. And whenever people talk about MELI's mode and its defensibility against competition, the conversation pretty much always returned to logistics at some point. And so the company has spent years building out this vast logistics network across Latin America, in many ways similar to what Amazon built in the US, just adapted to what are actually very different local conditions.
When a business grows fast, you pretty quickly realize that one of the biggest bottlenecks, especially in e-commerce, is just logistics. And in Latin America, that's not an easy problem to solve because you've got these regions that have very limited public infrastructure. And at the same time, you have these massive, densely populated mega cities. So it's a pretty complex environment that you have to work in. And for a company of MELI's size, relying on third-party carriers just wasn't a viable long-term solution anymore. You can start that when you just have the business growing and you're at a small scale. But over time, if you want to be the number one shop for people everywhere, basically, you have to be fast wherever you can be. And especially as the business has scaled through the 2010s, they had to make a decision, and that was to build their own logistics network. Once again, basically a copy of what Amazon does. And they call it Mercado NVRs. And over time, that expanded across the entire stack. So we are talking warehousing, fulfillment, sortation, cross-docking, last mile delivery, and eventually even air transport with the launch of MELI Air and its own fleet of airplanes that you can see now here on the screen. And at the end of the day, there are really only two things that matter most for e-commerce companies, and that's, as I said before, pricing and shipping. And Amazon is the company that figured that out early on by being both the cheapest marketplace and the fastest delivery option. That's essentially the model that MELI has managed to replicate in most of the big markets in Latin America.
That's really the first big flywheel you see with these e-commerce giants all over the world, right? Once shipping becomes fast and reliable, e-commerce actually turns into a legitimate alternative for customers and not just some niche use case they might consider occasionally. And then that pulls more people online, which expands the overall market and then attracts more merchants, increases the selection and the diversity of the offerings, and then brings in even more customers. And so all of that in turn just continues to reinforce investment into the underlying logistics network. And because building these logistics networks is incredibly capital intensive and operationally very complex, they do sort of naturally become a barrier to entry. And it's one of the reasons why most regions end up with having their own singular dominant e-commerce player instead of having Amazon simply taking over the entire world or having multiple players really competing with each other equally in the same market.
You can quickly forget that when these companies start out, there aren't that many advantages that you can have over the dozens of competitors that actually try to do the same thing. I mean, it wasn't a new idea that they had at all. And you can imagine in 1999, they weren't the only people coming from the US, having studied there, going to either Argentina, Brazil, or Mexico, and trying to set up a new business. At that stage, you just need a mix of just good execution, obviously, but also just a ton of luck. And as the business grows, that's when you can start doing or differentiating yourself by making better decisions. And logistics is one of the first areas where you can actually build a meaningful edge in this business. Another really important decision that they have done really a perfect choice by is essentially starting a second flywheel, and that was the creation of Mercado Pago. You can think of it as probably the Latin American version of PayPal or Alipay. I mean, it's growing fast, so maybe comparing it to PayPal is not the best idea. It's probably closer to Alipay. And in the early days of Latin American e-commerce, as I said, trust was a huge issue. So people simply didn't feel comfortable transacting online, and sellers were worried that buyers would just receive the product and then initiate chargebacks, so they actually never get paid. And buyers, on the other hand, they didn't trust the product that would actually arrive or that it would match the description. I think I told you and Clay before that the first times I ordered on eBay, my parents were already scared that we would pay for the product, but it would never actually arrive. And as I also said, sometimes they were unfortunately right. On top of that, many of the countries that MELI operated in, they were just still largely cash-based economies. So you just had low debit and credit card penetration. So even if you had the best marketplace and they would want to buy something from you, they simply couldn't. So initially, Mercado Pago was basically just the idea of enabling a secure payment system for the marketplace of Mercado Libre. And that pretty quickly actually turned into this realization that they said, well, this could be much, much bigger. We could become more than just a payment feature and actually become a mix of payments, banks, and just a backbone of the financial structure in Latin America.
We're trying to talk about the business as a whole, and then you have these distinct units with the Mercado Libre side and the Mercado Pago side. And so trying to do that simultaneously, I think is a little complex, even though they go hand in hand. So let's just start with the core Mercado Libre business, the marketplace itself, the logistics, we've already talked about a little bit, and then also this kind of promising advertising business that they're starting to spin up. And then we can look over at the Fintech side of things and figure out how it all marries together.
Yeah, whenever you have a company that has either one big flywheel or even multiple flywheels, it's kind of hard to break down just one part of the business and not get lost in this overarching flywheel, just connecting all of them. But maybe before we even do that and go into the individual pieces, it's probably also helpful to just zoom out a bit and get a sense of MELI's overall size. So basically, we are talking about a company that is doing about $25 billion in revenue today. About 60% of that comes from commerce, and the remaining 40% comes from fintech. So it's already a pretty balanced business, at least if you compare that to what most people think, which is basically just a marketplace. What's interesting is that this mix has been fairly stable over the last few years. After the COVID boom, you obviously had the fintech business that outperformed the e-commerce business. But in the last couple of years, growth rates have been about equal on average.
Well, so I said I wanted to talk about the e-commerce side of things, but I do just want to quickly ask, I mean, why did fintech outperform so much in 2022? Is it something to do specifically with the e-commerce boom during lockdowns and COVID? Or I mean, how do you think about all that?
I think the boom in e-commerce has mostly been during 2020 and 2021. And then in 2022, you had this post-COVID slump where the market overall, but especially tech stocks, were sold off because, surprise, surprise, they couldn't grow 50% a year to eternity. And then people started just going out again. And going out again, of course, is not the best if your business model is to be an e-commerce platform. And obviously, that meant that growth rates slowed down a bit. But also the fact that fintech took over in that period, where it basically sometimes had quarters growing triple digits, was mostly due to the launch of credit cards in late 2021. So it didn't really have anything to do with the e-commerce business. It was more idiosyncratic. And in the last few years, growth rates have been pretty similar for the fintech and the e-commerce business generally. So that 60-40 split is fairly stable. If I would have to take a guess, I'd probably say fintech is outgrowing e-commerce in the long run, but still, right now it's fairly stable. And what's funny, actually, if you would see that if you look at the graph that we currently have on screen, is that when one business grows slower than usual, the other one actually balances this out. If you know why that could be, please let me know, because I thought about it and I figured that it has to be idiosyncratic. In my mind, if anything, they should perform well or less well simultaneously. So I guess it's just a coincidence, especially if you have these young businesses like fintech still is. Just onboarding more people to your credit card, for example, can create huge jumps in growth in one quarter and doesn't necessarily have anything to do with how your e-commerce platform performs. And in terms of geographies, which is probably another important point, Brazil is MELI's biggest market, accounting for about half of overall revenue, followed by Mexico, and then the home market in Argentina, which are about equal in size in the low 20s percentage-wise. And it makes sense if you would look at how much each country in Latin America is contributing to e-commerce in general. Brazil is the biggest market overall.
On geographies, is there a difference between these countries when you compare the commerce side of things versus the fintech side of things? So, for example, is MELI stronger on the commerce or fintech side in the Brazilian market?
There is such a difference. And I would also say that's why the economics vary quite a lot from country to country. So Argentina, for example, which I already said is the home market of Mercado Libre, is a pretty good example of how that mix can change the economics, basically. MELI is the undisputed number one in e-commerce there. But even more importantly, Argentina is by far the most fintech-driven market in the entire ecosystem. If you would compare the percentages of market share in just commerce, for example, between Brazil and Argentina, it's not that different, but the fintech part of the business is a lot different. So to put just some numbers on it, in 2023, about 2/3 of MELI's revenue in Argentina came from Mercado Pago, which is the fintech arm. And compare that to Brazil, where fintech is closer to 40% of revenue, or Mexico, where it's basically the same, but even lower, about 1/3. And that difference in mix shows up very clearly in profitability. Argentina consistently posts what Mercado Libre calls direct contribution margins in the mid-40s, while Brazil and Mexico sit closer to the high teens or the low 20s. And that margin basically answers the question, for every dollar of revenue that Mercado Libre earns in a country, how much is left after covering the direct costs of serving that revenue? So that is the revenue minus all the variable costs involved. And since you looked at Nubank, Shawn, you won't be surprised that this fintech business is quite high margin. On the commerce side, incremental revenue tends to come with a lot of variable costs attached. So every additional order comes with fulfillment, warehousing, shipping, and often even subsidies to keep delivery fast and affordable. So even if GMV is growing nicely and the take rates are healthy, which they are, I mentioned before, they are about 20%, which is pretty good for a marketplace like that, a meaningful chunk of those revenues still get eaten up by costs. Fintech, as I said, looks very different, especially in a more mature market like Argentina, where once the payments and the credit infrastructure is in place, the marginal cost of generating yet another peso of fintech revenue is just much lower. So there's very little physical infrastructure involved, and most costs don't scale linearly with volume. So yeah, that's why Argentina, which is much higher in fintech penetration than most other markets it's operating in, consistently delivers the highest contribution margins, and why shifts in the commerce versus fintech's mix have such a big impact on Mercado Libre's reported profitability across all countries they operate in. As you know, my co-host Shawn and I are obsessed with analyzing companies. But you probably have noticed from personal experience that talking stocks is not everyone's favorite hobby. And I'm reminded of that every time I bring up investing at dinner or when I'm out with friends. They tolerate it for about 10 minutes, but then I get this look. The one that says, we get it, you love stocks, but this is not the place. So Shawn and I thought, why not build that place? And we did it. It's called the Intrinsic Value Community. Our members range from pilots and firefighters to lawyers and engineers, but also hedge fund managers, actual rocket scientists, and CEOs. And despite those different backgrounds, what connects all of us is the passion for value investing and continuous learning. And each week, we host live calls, covering everything from vetting the group's best stock pitches to analyzing portfolios, investing case studies, and conversations with expert guest speakers who are either prominent portfolio managers, CEOs, or authors. And the best thing is that if you ever miss a call, we have a library of recordings for watching back every single call we've ever hosted. And if you prefer reading over watching, well, then we have dedicated spaces in the community to share write-ups, discuss investing ideas, or just your thoughts on the general market. And multiple times a year, we bring the community from the virtual world into the real one, including private dinners in Omaha for Berkshire Weekend and meetups in New York City to explore, hang out, and most importantly, talk stocks. Our last cohort of members brought together 20 incredibly thoughtful people, some of the sharpest investors that Shawn and I have ever met. And if you want the chance to learn alongside people like that, you should join our waitlist at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community.
Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. And that's what we like so much about a company like Nubank, right? If you look at their cost metrics, you see how much more efficiently run they are versus legacy banks because they have this freshly built digital infrastructure that comes with very few variable costs. Whereas you contrast that with the legacy banking system. I mean, come on, you got physical branches and thousands of employees manning those branches. And so there's many more variable costs to scaling the business, which just makes those businesses structurally less profitable, right? To serve more customers, you need more branches and you need more people working those branches. Whereas Nubank, it's all software, right? They maybe have an AI assistant and it's an app and it's all downloadable and it's all, very minimal variable costs. So while physical infrastructure in e-commerce is sort of like a moat, it is more of a burden in the modern financial sector because the financial sector has become digitalized. And so when I look at Mercado Libre, you might say that they might have an easier way to acquire new customers than Nubank. And so what worked phenomenally well for Nubank, just for context, has been word of mouth marketing. And so they didn't need to advertise. But at some point, that will probably no longer be the case, especially when it goes from being, their primary market opportunity is acquiring customers who are unbanked to really trying to take customers from other banks. And so Mercado Libre, on the other hand, has its own marketplace in place. And so whenever a customer is checking out, MELI can just quickly chime in with an offer to pay with their own credit card and get cash back or points, or to spread out the payments and whatever it is. And then boom, you've got a new customer acquired into your fintech ecosystem. And then you have a whole funnel that probably moves them from, one credit card to other credit cards to savings accounts and different financial products as they get deeper and deeper into the ecosystem. And so, that whole process worked very effectively for Amazon in getting me to sign up for their card. And now I'm a very loyal user of it.
I immediately have to think about you when I read that, because I was like, this sounds exactly like the kind of program that even if I don't know Mercado Libre as a customer, I know how it is to just suck people into the ecosystem because they get these little benefits. And it just works perfectly well. You're basically driving down customer acquisition costs close to zero, or as close to zero as they can get. And at the same time, and you just mentioned it, you can turn someone who might only use Mercado Libre occasionally into a much more frequent user across payments, across commerce, and eventually even credit. And I gotta admit that of all the business models that we've looked at on this show, I honestly think MELI has one of the strongest flywheels out there, at least when I compare it to the growth opportunity that is still ahead for the company. Logistics is another really important piece of that flywheel, obviously. And Argentina isn't just more profitable than Brazil or Mexico because fintech is further along. It's also because the logistics infrastructure is largely built out already. And that means you just have much lower incremental capex today because you basically did all the investments in the last decade. And in Mexico and Brazil, that's not the case yet. So MELI is still actively building out warehouses and building fulfillment capacity and just last mile coverage in general. And that obviously costs a lot of money. So margins there are basically under pressure, I would say, by design for at least a couple of years, probably at least a couple of quarters. But once those logistics investments slow down and utilization improves, well, then margins in those markets should expand quite meaningfully.
Why don't we just zoom in on the logistics side a little more? Because it's such a crucial part of understanding the moat for both Mercado Libre and Amazon. And maybe while you walk us through that, we can also compare MELI to some of these other players on the space like Shopee and Temu, which, as far as I know, don't really have that kind of physical infrastructure in place yet. And so the question is whether that's a competitive advantage or competitive disadvantage for those businesses.
So whenever we talk about the logistics part of the business, technically we are talking about Mercado Envios. And I think I pretty much found the pronunciation for any Spanish speakers out there. So again, I apologize for that. But generally, you have a pretty sophisticated and by now just a multi-layered logistics network that is definitely not the way it started out. In the beginning, when it launched in 2013, it was basically a way for MELI to just negotiate better shipping rates with third-party carriers that did most of the job and to just bring a bit more consistency into the experience for sellers who were shipping their orders and also for the customers who received them. So that helped a lot in the beginning, and the setup was very similar to what MELI now calls its flex model. So the seller is holding the inventory, then hands the package off to a courier, and that courier is contracted by Mercado Libre and takes care of the last mile delivery. And from there, the network basically evolved step by step. So today, Mercado Envios offers 3 different logistics services, each designed for a different stage of, basically you can say, seller maturity. So the more scale they have, dependent on that, you would decide what part of the subscription or the logistics network they would use. And the first is called Full, which is the closest you can go to the FBA program, Fulfillment by Amazon. And basically in that model, you have sellers that store their inventory in Mercado Libre's fulfillment centers, and then MELI takes over everything. So we're talking packing, shipping, and delivery, the entire process. And then there's cross-docking, where sellers basically bring their packages to a MELI-operated hub, and from that point onward, MELI handles sorting and transportation through its own network. And then finally, kind of the legacy part of it, you still have this flex alternative, which just says, okay, well, sellers ship directly, but they still benefit from Mercado Libre in terms of negotiated carrier rates and also the logistic tools that they use.
And when we zoom out a bit and compare it to what Amazon has built, there are, I think, some interesting nuances, but also some differences. MELI now operates a logistics network that spans dozens of fulfillment centers, but also hundreds of these smaller hubs, and then thousands of pickup and drop-off locations across Latin America, as I understand it. And so The transportation network includes its own fleet of aircraft with MELI Air and branded trucks, and this large last mile fleet, much of which is run through these partner carriers. And that last mile part, I think, is actually one of the most important distinctions. Amazon's logistics network became really what it is because they've chose to own the major components of it. And so Mercado Libre has consciously taken what I would say is a very different approach. Their network is built with a mix of owned and leased facilities, and most of the transportation layer still runs through these third-party partners, and that has kept the business much more capital light. But then my concern would be if you have less direct control over the entire process, the cost of that would be sort of in the difficulty of trying to maintain as pristine of a record of reliability like Amazon has, where Amazon really controls everything from end to end to ensure a certain timeliness and quality.
Well, one of the reasons why they did it is just because of the volatile nature of emerging markets. What you don't want to do is spending billions of dollars in infrastructure in a certain country, and that may no longer be part of your operations in 5 years. I mean, that's obviously not what MELI expects for markets like Brazil, Mexico, Argentina, but it's probably a mindset they got from past experiences in smaller and less stable markets. We talked about Venezuela when we had our guest talk on our sister podcast, We Study Billionaires, which is a market that has been important for MELI in the past. But then at some point, hyperinflation hit, the economy broke down, and basically, in a matter of a day or let's say a week or two, it's not an important market for MELI anymore. And if you have billions of dollars in infrastructure in those markets, it's obviously a huge hit for the company. That said, they're not standing still either. Last year, the company announced plans to double its fulfillment capacity in Brazil by the end of 2025. And they have acknowledged that building out that much space obviously does pressure margins in the short term, since new facilities take time to reach optimal utilization, but it's definitely the best choice that they can do in the long term. And I just like, and you would see that if you look at the financials, that over time, the more scale they reached, the more they doubled down on more capital intensive investments. So when they weren't sure yet whether a market will be a successful one in the future, they were more capital light in how they invest. And now if you have these big markets like Brazil, for example, they know it's about investing heavy in those markets, get your market share up, defend it, and then you can go on to the next country. And to your concern, I think that's valid. I think my understanding is that they use those small and local carrier services where MELI is basically the only or at least the biggest customer that they have. And because of the local factor and them basically being the only or the most important customer, they have an eye on the performance of the carrier and possibly even a say on the operational side of the business. And it seems to work pretty well. I mean, about 94% of packages are now delivered through its own network, and 74% of them are delivered within 48 hours. And another important point is, just talking financials here, that logistics is still largely unmonetized. So MELI hasn't pushed hard on any fulfillment fees or other monetization levers that you can pull in the logistics side, as Amazon did, for example, with the FBA program. So the company has really repeatedly said it wants to reach higher and more consistent fulfillment adoption before fully leaning into monetization. But when you look at the numbers that I said prior, I think you're probably at a point where you can make an argument for monetizing logistics in maybe the next 1 or 2 years, which could also be a huge driver for the financials. And now getting to your original question about competition as well, the existence of this logistics network is one of the clearest lines separating MELI from newer entrants like Shopee and Temu. Shopee initially entered Latin America with local marketplaces in either Brazil and Mexico and Chile and even in Colombia and Argentina. But by late 2022, they had shut down most local operations, actually every single operation except for Brazil, and shifted to a cross-border model everywhere else. And that means most orders are shipped from abroad and then rely on third-party carriers as soon as they get into the country. However, in Brazil, they have become pretty fierce competitors. Actually, it's probably one of the points that I haven't looked into enough in the beginning because I thought Mercado Libre is just so dominant. But Shopee has done a phenomenal job in the last couple of years and especially in the last couple of quarters. They have about a 17% market share, making them the second largest player after MELI, which has about double that market share. And in terms of logistics, MELI has about 2 million square meters of distribution space, but Shopee has about half of that. So it's not like they're not building infrastructure at all. They're also there. They joined the party later, but still, if you think about the decades that MELI is still in the market and the couple of years that Shopee is in the market, having half the amount of, or the number of million square meters in distribution space, that's not unsuccessful expansion at all. And by the way, to give you a perspective of how large that actually is, because I otherwise would have no idea either, 1 million square meters is the size of about 17 American football fields. Now, I would need to know if that's the same size as European football fields. I don't know that for sure, but I think it's about the same size. So, yeah, just summarizing or saying it in short, a major difference is just density. So, Shopee has a very limited same day delivery network because most of their network is still in these largely populated cities, but they cannot really make same day delivery outside of those mega cities. And Mercado Libre is able to do that.
For Mercado Libre, a 35 to 40% market share in Brazil is, for context, about the same size as Amazon's market share of e-commerce in the US. So we wouldn't want to dismiss the competition here, but I do think it's important to make clear just how strong their relative positioning is. And so let me ask you, I mean, do you think Shopee's strong results in the last few quarters, is that what has driven the sell-off in MELI's stock? Is that really the primary concern? Because at the time of recording, the stock's about 25% off from its all-time highs.
I guess it's part of the underlying fear that more competition will make the business less profitable in the long term. But on the other hand, if you look at C's Limited stock, which is the parent company of Shopee, it's down almost 40% from the year's high. So it hasn't really benefited either. And even Coupang, the company you mentioned before and that you looked at in the beginning or the first couple of episodes here on the show, the South Korean retailer, it has had a very tough year. That's a bit different over there because they had a huge data leak, which was very bad for the company and the publicity. But still, I would say the overall business model of e-commerce companies has just been not the investors' favorite over the last couple of years. And I think investors generally believe competition could hurt both companies. So Mercado Libre, but also Shopee, as they could undercut each other on pricing. And then, yeah, add to that the general discount for the instability of, let's say, Argentina and maybe even Brazil. And you quickly get to a price where you would say it's still trading at 30 times. So it's not like it's incredibly cheap. And honestly, I mean, even Amazon, look at the stock chart. It didn't perform well in the last 5 years. So I think it's a mix of having basically the business model of payments and e-commerce, and both of these industries sold off in the last couple of years. So I'm not surprised we're not at all-time highs right now.
And then there's Temu, which is a company that, like a lot of Americans, I had never heard of until suddenly it seemed like they ran like 6 Super Bowl ads in a single year a few years back, which is a lot when you consider how much a single Super Bowl ad can cost in the plural millions. But since then, at least anecdotally, it kind of felt like there was a peak in interest in Temu just because of the fascination and how ridiculously cheap some of the things were being sold, or at least the way they're being priced in advertisements. And I think maybe closing the de minimis exemption and then some of the tariffs in the US have probably zapped some of their momentum. But I mean, what about Temu in Latin America? Are they another fierce competitor for Mercado Libre that we need to be really kind of concerned with?
I think the picture looks pretty similar, although it probably wasn't the Super Bowl ads that put it on the radar there. Unsurprisingly, Temu is even more dependent on cross-border shipping than Shopee is. And nearly all the assortment comes directly from China. And Temu has gained a lot of app engagement, especially in Brazil. But without local fulfillment centers and last mile assets or even just pickup point networks, it can offer low prices, but not necessarily the part of the equation, which is speed. And that limits its relevance for these high frequency categories where speed and reliability matter a lot. And one thing that we often see when you look at e-commerce companies is the importance of being dominant in categories that people shop oftentimes. So clothing is actually a big factor there, and Temu is very successful in that. But if you look for clothing that you want to buy again and again because the quality is good and delivery is fast, Temu is probably not that one company. Amazon is the company that, if anything, competes with MELI for these higher quality companies. And it has expanded fulfillment capacity in Brazil and in Mexico in recent years. But they haven't really gained share in a meaningful way, especially in Brazil. And that might be because ultimately the logistics network is not on MELI's level, or because they lack the Fintech arm that Mercado Pago is, or perhaps simply because there are still so many other priorities that Amazon is tackling on. I mean, we just talked about cloud. That's where they make most of their profits. So to assume that they would rather expand e-commerce, which is a business they don't make much money from, in Brazil than focusing on actual profit drivers is probably not the way to go for them. And if I had to take a guess, ultimately, I would say it's a mix of all of them. And this is likely not going to change in the future either. And maybe as a last point, and it kind of goes to what you said about Temu, I wouldn't underestimate the fact that countries generally have an incentive to favor local players. I mean, sure, MELI is an Argentinian company, but the vast majority of its products come from local, small and medium-sized businesses in the countries where it operates. So when Chinese players enter, that also means that sales volume that would have gone to Argentinian, Brazilian, or even Mexican SMBs now goes to huge companies in China. And MELI's management has actually already made public comments about this. And in early 2025, Mexico imposed a 19% VAT on packages imported from countries without a free trade agreement, like China, for example. And for packages under $50, which were previously duty-free and is most of the volume that Temu sells in these Latin American markets. And this measure explicitly targeted these ultra cheap imports from platforms like Shein and Temu that exploited the de minimis exemption.
Our boss and the co-founder of the Investors Podcast, Sig Broderson, he always likes to remind us that it is not necessarily the best product that wins. And I think that's something we should keep in mind. We had a discussion like that when we explored Uber as well, and it might be the better product, but that does not stop thousands of taxi drivers and unions from protesting or putting pressure on politicians to make changes. And so this is the type of stuff that does matter in the real world, but just can't be seen from looking inside of a spreadsheet. But I think we have a pretty good understanding of MELI's ecosystem now. So if you had to sum up the flywheel, how exactly would you do that in maybe a few sentences?
So at the center of the flywheel is basically this classic marketplace flywheel. So you got more buyers that attract more sellers, and more sellers attract more buyers. And that part is pretty straightforward, but Mercado Pago and Mercado Envios, they add a new layer to this. So for sellers, listing on Mercado Libre almost immediately leads to using Mercado Pago as well for the payments part. And that gives sellers faster settlement, better fraud protection, and just a standardized checkout process that buyers trust if they're on the platform. And once you start to scale, many sellers move into Mercado Envios as well, letting MELI basically handle fulfillment, shipping, or at the very least, sorting and last mile distribution. And at that point, a merchant is just so integrated into the system and dependent on the sales coming from MELI that they also start using Mercado ads to promote their listings. And some sellers might even end up extending into Mercado Credito, which is basically MELI using working capital loans and funding inventory or managed cash flows tied to sales on the platform.
As some of our listeners will know, I mean, there are very few business models that we get more excited about than advertising. So let's talk about that more. MELI seems to have what I would say is a very compelling setup to successfully launch an ads business. And Amazon, for reference, has become the third largest advertising business in the US and globally is responsible for more than 10% of ad spending. So those are some big shoes to fill. And that is just a crazy statistic when we think about everything else Amazon does and does very well. And so the strength of the value proposition, I think, for merchants is that Amazon owns the point of purchase. When you log into, the Amazon website or pull up the app, there are very few moments in any other point in your life in which you're more willing to buy something and spend money than when you are actively browsing a marketplace like Amazon or MELI. I mean, for me, it's like an entrenched just reflex. I see something, click ad, and it feels, well, the problem is that it doesn't feel real at all. It doesn't feel like you're spending money. It feels almost like a game. So, I mean, the ads hit a customer at the best possible moment with the highest incremental propensity to spend. And with all that data they have on customers, they also know exactly what those people are looking for and probably how much they want to spend too. And so again, we frequently discuss ad businesses and focus on what differentiates successful ones from the ones that end up failing. And I think two of the critical factors that really do matter are having personalized data and then the available real estate, for lack of a better word, the digital real estate to display the advertisements. And Amazon and MELI have arguably the best data and definitely the best real estate, really, of anywhere.
Absolutely. I mean, creating an ads business is one of the most natural things that MELI can even do. And I think you said before that it's also the part of the business that makes you most excited. And it's still in the early innings It's only accounting for about 2% of GMV, but it's growing fast. It's growing 50 to 60% year over year. And a stat that surprised me is that it supposedly already accounts for about 50% of the digital retail ad spending in Latin America. And for perspective, Amazon sits at about 16% and Shopee has less than 5% market share. And both of them, Amazon obviously, but also Shopee, have advertising businesses. And this is just another advantage for MELI because not only is it a profit driver, but it also attracts, once again, merchants looking to scale quickly because no other platform can match Mercado Libre's user base and also the reach that you can basically get through just running ads. And MELI also recently launched offsite ads, so talking about real estate, which means they can now also target you on apps like Disney Plus or on Google and even other platforms using data from their marketplace. It's kind of similar to what PayPal is also doing and what we talked about in that episode. And that said, if I probably had to speculate, I would guess that the uptick in market share for the other parts of the graphic that we currently here show on the screen is due to Shopee gaining share over Walmart and Amazon. Because what you see here is that, especially over the last 3 years, Amazon and Walmart are losing a lot of market share in the ad spending. And the other parts, which is a gray part here on the graph, is substantially growing. And the only company that I could think of which is responsible for that is probably Shopee, especially considering the market share that it's having in e-commerce. And what's potentially interesting is that MELI also launched its own streaming service in 2023. It's free, so it's only powered by ads at this point, and content comes mostly from players like Disney, HBO, or other local movie studios. And with all of these players, MELI has revenue sharing agreements. So this is once again a less capital intensive approach to offering a streaming service than producing shows in-house, which tends to come with a lot of high costs.
The parallels here with Amazon just keep coming. Obviously, Amazon Prime has long included Prime Video as an aspect of it, and it did used to be free entirely, and now they've started charging for you if you want to bypass ads. And then over time, we've seen Amazon make bigger and bigger bets on streaming, and whether that be in producing their own content or in getting the rights to major sporting events like Thursday Night Football every week with the NFL. So it just sounds like for MELI, the streaming app, I'm sure, is part of their loyalty program of sorts too. And it'll be interesting to see how much they're able to recycle back into it. Will we see them hosting, major sporting events, getting the rights to, soccer matches, stuff like that on that app too?
Yeah, just brought up the loyalty program, which is kind of like Amazon Prime. It's called MELI Plus, and again, conceptually, it's very similar to Amazon Prime. Customers pay a monthly or an annual fee in exchange for free or discounted shipping, faster delivery, and then these bundled digital benefits like streaming or music, shows, all of that stuff, which is basically known for any Westerner from Amazon Prime. And we don't have exact numbers since MELI Plus isn't broken out as its own segment, but management gives some pointers on earnings calls here and there. And MELI Plus appears to reach about tens of millions of subscribers across Latin America, which Brazil and Mexico as its core markets. And adoption has been steadily increasing as delivery speeds improved and as the bundle became more attractive. I mean, we talked about Amazon Prime and how it's just a no-brainer. If there's a subscription I would need to get rid of, probably the last two would be Spotify and Amazon Prime. And I'm not yet sure if MELI is the same type of a no-brainer or MELI Plus. But again, it appears to reach tens of millions of subscribers across Latin America. And since they go up all the time and people buy more frequently and they spend more time on the app, most importantly, probably, is that management consistently highlights that MELI Plus users are just meaningfully more engaged. So they buy more frequently, they spend more per user, and they are more likely to use Mercado Pago across both offline and online transactions. And from a financial standpoint, Mercado Libre has been very clear that MELI Plus is not yet optimized for profitability, which does not come as a surprise if we're being honest. It's pretty much like Prime in Amazon's early years. The program is mostly run close to break even or at a small loss at a standalone basis. But what you want to achieve with this service is just higher lifetime value of a customer. You want more GMV per user, you want higher fintech penetration, you want lower churn, and obviously better unit economics across the entire ecosystem. And that's why you build these loyalty programs or subscription services.
So when we're thinking about Mercado Libre, I was just Googling what MELI Plus costs, and it's about $2 or $3 a month in USD terms. So you really need a lot of subscribers to move the needle. But I mean, as you said, it is really basically the Amazon playbook here. And to some extent, it's another layer for the flywheel. I guess the question I would really be most interested in is for that, let's say $2 to $3 a month, depending on where you are and, exchange rate fluctuations. Do people feel like MELI Plus is a service they can't live without? I mean, I think there's probably 100 million people in the US that would say Amazon Prime is a subscription they're least likely to cancel out of everything, kind of like you said, Daniel. And so I just wonder if there's that same loyalty. I mean, with Coupang, we saw that with very much being true in South Korea, where the product just multiple times over completely pays for itself. And so people just almost can't fathom not being subscribed to it. So it's not as clear to me just because you're the one who's done the research on Mercado Libre of, whether there is that same sort of loyalty. But, maybe since we've been looking at this from the merchant's standpoint before a little bit, I mean, how about from the buyer's perspective? So, I mean, a customer uses Mercado Libre occasionally, maybe for a few specific purchases. And then over time, they notice that items fulfilled through Mercado Libre tend to arrive faster and more reliably than elsewhere. And that improves trust and better delivery, and buying online becomes a lot less like gambling and more of a habit. And that's how we start to talk about this being a service that few people feel like they can't live without and pays for itself. And then from, Mercado Libre's perspective, as purchase frequency increases, you can also have the chance to integrate Mercado Pago, which that starts to make more sense, right? It's convenient, it's widely accepted, facilitates more transactions. It just really is the smoothest way to check out. And so once a buyer has reached that point, which tens of millions of people have, signing up for MELI Plus, I would think more or less is a natural next step. And, that includes free or discounted shipping, faster delivery, easier returns, and all these bundled benefits, whether you're talking about streaming too, once you're ordering regularly. And then all that just starts the flywheel loop over again, reinforced by MELI Plus and higher frequency, driving greater logistics density. And that leads into better delivery speed and reliability. And so, I mean, that is a painstaking breakdown of a flywheel, but it is a self-reinforcing business. And that's one of the most attractive things we like about it, where it's shared economies scaled, as they would say, as Nick Sleep would say. A lot of benefits are being recycled and reinvested back into consumer surplus.
It's spinning. The flywheel is spinning. And I think that's what's so interesting about it. And you mentioned the pricing of MELI Plus. If you actually compare it to the pricing of Amazon Prime in Latin America, you will see that Amazon Prime is a bit cheaper than MELI Plus. So seeing the growth compared from MELI Plus to Amazon Prime, despite being a bit more expensive than Amazon, just makes me think that it's the exact same no-brainer that Amazon Prime is too. And there's certainly signs that the e-commerce market in Latin America, and especially in Brazil, will get more competitive over time. And Shopee has done a great job in recent years. But in my mind, no one except MELI offers the full ecosystem where every part reinforces the other. And once again, going back to MELI Plus, that's why the flywheel is so strong and why I think it's basically the same no-brainer as Amazon Prime is here, because they have the full ecosystem. They even have the payments part, which Amazon does not have, which is probably a huge thing. Because if I think about what I actually use Amazon Prime for, it's surprisingly not a lot of things. I maybe buy something on Amazon once or twice a month. I don't watch Amazon Prime Video a lot. So there are not many things that actually hold me in the ecosystem, and I still wouldn't give it up. So I'm pretty sure that MELI Plus is actually, even now, a huge value add to all the customers. But still, I mean, I'm sure Shopee has plans for a similar ecosystem, and MELI already has 40% market share, which is, especially in commerce, a huge help. That's close to 80 million users, and Mercado Pago has about 70 million users. So you tend to see that if you use Mercado Libre, you're also likely to use Mercado Pago, and that just makes it the biggest player in Argentina. It's the second biggest player in Mexico after Amazon, and in Chile it's the biggest, and then once again in Brazil it's the biggest as well. And on the fintech side, it's the biggest behind our portfolio company, Nubank. So it's just incredibly successful in all the markets that it operates. And Temu is a good example of why or where Mercado Libre's flywheel really shines. Temu is excellent at attracting these price-sensitive users and driving app engagement on price alone, and it often wins if you just play that game. But Temu operates almost entirely cross-border, as I mentioned, without local fulfillment, last mile, dense pickup, and all of that stuff. And as a result, you just struggle with consistency, with speed, and especially in categories where reliability matters, you just can't compete. And Timo also lacks the surrounding ecosystem. So those are the type of players where I do not fear that they could build an ecosystem, subscription services, ads that can actually compete with Mercado Libre. So I hear a lot of talk about Amazon being the biggest competitor. That might be true, especially on the higher quality front, but I don't see them growing. I see Shopee growing a lot, but then again, it will probably take a lot of time until you get the same ecosystem, and combined with the fact that local governments will probably favor the local champion, and you already have all that market share, I think it will be incredibly difficult to create the same flywheel and ecosystem as MELI has. And losing some customers here and there on pricing is probably not the biggest threat if you're operating in a market that's supposed to grow 10% a year for the next 10 years.
We've kind of danced around the fintech side of the business a little bit, but I don't think we've really dug into the numbers specifically yet. So, I mean, let's do that. Let's take a closer look at how Mercado Pago is actually performing beyond just sort of the strategic importance within the broader Mercado Libre ecosystem.
Generally, there are three ways that Mercado Pago can be or is monetized. And at the core, Mercado Pago is still a payments business. So it processes transactions on and off MELI's marketplace. And in fact, it processes more transactions now outside of MELI's marketplace than on it, which, at least in my mind, is a good sign that you get broader adoption and people are actually users of Mercado Pago for the service itself, and not only because it helps them on the marketplace. So online, merchants might use Pago as a checkout solution, and offline, it shows up through QR code payments, which are a huge thing in Latin America, as you also know by researching Nubank. And it also sells point of sales devices in physical stores. So Mercado Libre then earns a little fee on each transaction, similar to traditional acquirers. Then the second big chunk of revenue comes from credit. So interest earned from Mercado Pago credit cards, or loans and advances it's either granting to consumers or to merchants. And lastly, you have so-called fintech products. Those are, for example, the point of sales devices that we talked about earlier that are sold to offline merchants. But this is really, you could look at the financials, a very, very small part. And it's more about the long-term game of onboarding more merchants and giving Pago users the chance to pay offline as well. And sales themselves of those devices account for less than 1% of total fintech revenue. So it's basically irrelevant from a financial standpoint.
Before our call, we were chatting, as we so often like to do. And you were telling me something about the asset management services that are embedded into this part of the business. But I think it's a small part of it. But I mean, could you paint some more color around what that looks like?
Yeah, it's interesting as well because there's a unit where you can invest your money into digital assets like cryptocurrency or just receive higher rates than in your traditional money market fund. And the idea is simply to keep as much money as possible in the Mercado Pago ecosystem. And it's working quite well. Assets under management have almost doubled from 8 billion in Q3 of last year to 15 billion in Q3 of this year. And again, it's not about making a lot of money from this, but I thought it's interesting because we often talk about payment companies, and especially if you look at Latin America, the use of stablecoins is a huge value add. So if you can just put your money into stablecoins on Mercado Pago, that alone is probably incentive enough to get even more funds that in the end, Mercado Libre can then work with.
Yeah, I mean, like you said, for users, I think it makes sense because if you can deposit funds into stablecoins that are pegged to the US dollar, it's probably going to be a better option for most people trying to save money than holding in their local currency, which Latin America has not the best track record in avoiding currency depreciation and sometimes very dramatic currency depreciation. So, I mean, looking at the three businesses here, the fastest growing right now is on the credit lending side. And in the last 5 years, it grew at a CAGR of, sounds ridiculous to say, almost 90%, which is double the rate of the fintech's service revenue overall, which are the transaction fees. And so, I mean, growth is not slowing down. And last year, the CAGR was still well above 80%.
I almost feel bad of it. So I will apologize in advance because I will bring up the flywheel again, but I can't stop talking about it on today's episode. With Mercado Pago's growth and overall transaction volume, MELI obviously got a lot more data on its customers than, for example, Amazon. Even though it's a huge marketplace, it doesn't have this payment arm. And all that data gives MELI an extreme advantage over every bank when it comes to underwriting credit and controlling risk. And unlike a traditional bank, Mercado Libre has real-time visibility into both sides of the user's economic life. So on the consumer side, it's about what they buy, how often they buy and how they finance things. And on the merchant side, it's how much they sell, which categories they operate in, and how seasonal their cash flows are, and even how they behave across every part of the ecosystem. And that kind of data is extremely difficult to get and extremely difficult to replicate if you're a bank without having this entire ecosystem.
Nubank is famous for not just all the data they collect, but how they've been able to successfully use alternative forms of data to help with underwriting loans, I guess you could say. And they don't have all the bureaucracy that legacy banks have, and that makes them a lot more nimbler in being able to test new things and build out their own data sets to determining what factors are more or less meaningful in trying to estimate whether somebody is ultimately going to repay their loan.
And it works pretty well. I mean, you can see the impact of that in the underwriting metrics. The most important ones are so-called NPLs, or non-performing loans, which we also talked about in Nubank's episode. There are 2 points in the loan timeline that you usually check for, and those are loans that go delinquent after 15 days, and then loans that go delinquent after 90 days. So Nubank's NPLs are noticeably lower than Mercado Pago's, which simply means a smaller share of its borrowers end up missing payments. They sit at 4% for the 15-day bucket and about 7% for the 90-day bucket. Mercado Pago's NPL after 15 days is 7%, but after 90 days, it goes up to about 17.5%. The flip side, though, is that Mercado Pago earns a risk-adjusted margin of a little over 20%, which is roughly double the margin of Nubank. And that's after all the credit losses that you have encountered. So in other words, Mercado Pago takes on more risk, but it also gets paid significantly more for doing so. And importantly, both of them carry more reserves than needed to cover all the expected losses. So it's not like any of those two companies is gambling and just speculating on another bull market for the next 10 years. And still, this is probably the part of the business that would come under pressure if one of the major economies that Mercado Pago operates in were to experience a serious downturn. The first one that comes to your mind would obviously be Argentina.
It's also, it's reassuring to see that these key lending metrics have remained stable for the most part. In fact, I would say both 15 and 90-day NPLs have actually declined year over year, despite that 80% plus growth in the credit portfolio we've talked about. And so, that strongly suggests growth is not coming at the expense of the credit cycle, which I say cautiously, but certainly the big question is whether that can persist across time in economic cycles. And as Buffett says, when the tide comes in, you see who has been swimming naked. And I certainly hope Mercado Pago has not been swimming naked. It doesn't seem like they have been, but that's always the concern. So let's talk about capital allocation though. And then in the same breath, management in general, because if we're trusting them to manage these underlying credit risks and not to be swimming naked, we really need to have a lot of faith in how effective management is and how well they're aligned with shareholders. So how do you think about that?
Totally. One of the most difficult parts for me to get comfortable with Nubank is probably understanding what data exactly you use and then looking at the management team. I think for Nubank, the management team is just perfect. They did a fantastic job over the last couple of years. And if you look at the NPLs, you also see that whatever set of data they're using, it works pretty well. Having said that, to me, it's probably easier to understand when your data comes from a marketplace that I know because I shop at marketplaces, every single month. So I kind of understand where they get their data from. But then again, they also just have an incredible management team. And one of the things that I said across the entire episode is that their capital allocation always made sense. They only spent capital when they thought, okay, it's really worth doubling down here. And they were willing to change business models over the time when they thought, okay, well, this is probably a better opportunity than the last time. And if you have a business like MELI, you obviously want money to be reinvested into the business and not be paid out in either buybacks or in dividends, especially given the very tangible advantages of all the investments they do. We often talked about infrastructure, but basically all of them. Even the credit has to be, especially, it's kind of an investment because you have to fund it upfront and only take the benefits of it later on. So there are instances where companies need to spend money on, for example, buybacks. For example, when they have high levels of share-based compensation. Investors don't like to get diluted. So when there's a lot of SBC, companies that can afford it tend to buy back shares to offset it. But it's kind of a slippery slope because on one hand, you're not getting diluted, which sounds great on paper, but on the other, it's your cash flow that is spent on those shares. So technically you still pay, it's just not in the form of shares, but in cash. And the great news about MELI is that there is basically no share-based comp at all. We are talking about less than 1% of revenue, which is lower than anything I've ever seen for a tech company at that scale. So all the money it earns can be reinvested in a business that has a return on invested capital of about 35%, which just sounds pretty good to me.
Oh, that's very good. And honestly, maybe that's the perk of looking at tech darlings outside of Silicon Valley, where there is this very entrenched culture of expecting stock-based comp. And yeah, if they can reinvest in growing their business profitably with very high returns on capital, then of course you'd rather see that to buybacks. And typically for more mature companies, they may simply have just less reinvestment opportunities. So buybacks can become relatively more attractive, especially if there's a lot of stock-based comp to offset, but that is just not the case here.
No, I mean, at least for the next couple of years, there's definitely not capital that you can invest profitably into the business. But on the other hand, I wouldn't be mad if at some point you have a business that is generating a lot of cash and you can give that cash back to shareholders in either the form of buybacks or in form of dividends. Whatever it is, if we see margins actually go up at some point, that would be fantastic. But we haven't yet talked about the management. So on that side, something that we both love to see is to have a business where the founder is still involved. And in this case, you have the founder in the person of Marcos Galperin, who has led the business from the time of founding to today as the CEO. And he's the type of CEO that I just like a lot. He's a great capital allocator, obviously, as we talked about today, but he understands the business very well and also the markets they operate in. And he has consistently focused on the business's long-term outlook and ignoring the short-term noise. And he's also not a promotional CEO. He doesn't attend earnings calls anymore, and he is not doing a lot of public speaking at all, but they actually have a podcast. So if you want to learn more about Mercado Libre, they have their own podcast, which is definitely worth checking out. But he's just very focused on the operational side. He actually stepped down as a CEO at the end of 2025, but he remains executive chairman. And with a 7% stake in the company, he's also highly aligned with shareholders. So I don't expect there will be any huge changes. I mean, the new CEO, he's been at the company since 2017 and was handpicked by Galperin. And Galperin also wrote a letter explaining why the transition is happening now. And I think he made it pretty clear that he has given a lot of thought to this decision and he wanted to ensure that this transition is definitely done the right way.
Again, it sounds a lot like Amazon. You had Bezos eventually step away in title from being CEO, but still for the most part remain pretty involved with the company. And we mentioned before how crucial the transition from founder CEO to the next in line can be. And there are companies where that has worked out well, like with Copart, but there are also many examples where it didn't. And looking at Galperin's track record across business and capital and management team decisions, I want to give him the benefit of the doubt that this transition will go smoothly, but that's always a risk, of course. And so kind of pivoting a little bit here, I should say for listeners who don't know, Daniel and I did do a top stocks for 2026 episode recently on our sister podcast, We Study Billionaires, with our friend and colleague, Clay Fink. And I pitched the Dutch holding company, Exer, and Daniel pitched Mercado Libre. And so in that pitch, you mentioned that margins used to be higher in the past, and we are now sitting at the kind of low double-digit range. And then in the mid-2000s, they were actually comfortably above 30% in terms of profit margins. And assuming that not everybody heard your explanation of that in this other podcast we did, how about you just explain that discrepancy once more for us?
It's definitely counterintuitive. Usually margins would improve when the business scales, and at least when your business model works, and it's safe to say that MELI's business model definitely works. What's different for them is that they have always been very cautious about spending money. That's what we talked about a minute ago. That's why they made a point of becoming profitable early to show that this model is actually working. We can build this, we can scale this, and other companies cannot compete with us on the same level. So they basically had these huge profit margins, you cannot really say it otherwise, early on. However, with scale and market power, they also became more confident to invest more heavily into the business. And the margin decline was basically starting in 2017 and was largely the result of deliberate reinvestment. So that was a period when the company was more aggressive on expanding its logistic network. It was expanding free shipping, subsidies basically to accelerate adoption and also pump up the utilization of the infrastructure that you now build. And then also they began scaling Mercado Pago beyond the marketplace. And each of these temporarily compress operating margins, but also dramatically strengthen the long-term competitive position of the company. One of the long-term advantages of free shipping, for example, is that the increase in volume makes the logistics network more efficient. And you can see that in the numbers as well. When free shipping was introduced in 2017, and it actually was again this year in 2025, MELI saw the largest quarterly addition of unique buyers in the company's history, which drove down unit shipping costs by about 8% in its biggest market with Brazil. And last quarter, unique active buyers increased by 26%, bringing the total close to 80 million. And the items sold per unique active buyer rose another 11%. So that's about 8 right now. So while margins today are pressured by things like free shipping, for example, I think the efficiency gains should lead to margin improvements in the long run.
And do we know how profitable MELI's marketplace is? Or, I mean, do we have a take rate to reference? As we know with Amazon, despite its huge scale, the marketplace itself is actually not really the ultimate profit driver. It's advertising, it's also AWS, and MELI does not have an AWS equivalent. So it does really kind of feel like the weakest point in the comparison with Amazon.
Yeah, unfortunately, and that was the most annoying part about researching Mercado Libre, they did not report any margins by segment, just as they do not give us a lot of details on MELI Plus or on ads. What they report instead are GMV, net revenue, and so-called direct contribution margins, which we talked about earlier. And once again, that margin is basically sitting between the gross and the operating margin. And as we talked about, it counts all the variable costs of the business unit, but not the company's overhead costs. So something like centralized R&D or G&A expenses, for example. And to get an idea of the take rate, you can just take the net revenue and then divide it by third-party GMV. And you would get a take rate of close to 20 to 21%. And that's not pure commission, obviously. That's also counting something like ads, shipping services, which, like I told you, do not make a lot of money right now, and a couple of other value-added services, for example, MELI Plus. And for context, third-party GMV is generated by products from independent sellers. First-party would mean MELI is the company behind the product. So Amazon's share of profits, as I said in the beginning, is pretty much 50-50 between third-party and first-party. And MELI is still over 90% third-party. So this proxy works quite well, and it's also the reason why for MELI, the marketplace is not a loss leader. And a couple of years ago, the take rate was still in the mid-teens. So there has been significant improvement here. So I would say that's promising, because if you want to see the take rate increase, it's mostly from value-added services. You do not want to pressure merchants over fees, which is not a durable way of improving profitability. And with ads expanding in the future and logistics moving further down the Amazon route, so becoming a service for other companies as well, I think the take rate should keep improving over time still.
All right. Well, we already talked about the margins of the fintech business a bit and how they're actually even higher. And Argentina, being MELI's most mature market, does have contribution margins of over 40%. So it might not be unreasonable to assume that Brazil and Mexico could at least reach the 30s in the next decade ahead. And with that backdrop, I think maybe we can finally get to the valuation part of today's episode. Daniel, I already spoiled that MELI was your top pick for WSB. So people probably can already guess that at least you're pretty bullish on adding it to our intrinsic value portfolio. And maybe that implicitly means it passes the valuation test. But let's just go through that and double check the numbers.
Well, let's just try to keep the arc of suspense for a little longer. So to be completely honest, before doing the valuation, I wasn't sure whether a 5-year valuation model with relatively modest assumptions would even rank MELI as a great opportunity on paper. So for my base case, I assumed revenue growth in the low 20s, something like 21, 22% over the course of the next 5 years, mid-20s for the first 2 years, and then slowing down to mid-teens. And in terms of margins, I actually modeled that we see a slight decline in margins over the next 2 years, about half a percentage point, followed by a recovery starting in 2027. And that will lead to 2030 operating margins of about 19%. I think that's realistic considering the 30+% margins that we already have seen in the past, even though it has been a long time ago, with a whole lot of changes in the business since then. And Net income margins, I assume, take a similar path, so they would end up slightly below 13% in 2030, assuming we leave the share count unchanged and we apply a 26 times multiple, which is definitely below the historic rate that it's trading at, and then using a 10% discount rate, which is 2 percentage points higher than our usual discount rate, mostly due to the geography I think MELI is operating in. They're doing a great job, but still you have these markets where, just as for Nubank, we kind of go with a higher discount rate just because it's basically a risk premium for the markets it's operating in. And after all of that, we end up with a fair value of almost $2,700 to $2,800. And let's be a bit more conservative and just apply another 20% margin of safety. And then we get to $2,200. That's still a 17 to 18% IRR from today's price of close to $1,900. If we are a bit more bullish and we assume that growth will be closer to 25% and operating margins might actually hit 20% in 2030, you could also underwrite a fair price target of about $3,000. At least when you put a multiple of 30 on it instead of 26, you could also say, okay, well, this stock is worth $3,500. So I think just on valuation terms, you could make almost anything seem logical if you are in a spreadsheet. On the other hand, and that's basically the full proof of it, you have the typical emerging market risk as well. And if you have a serious macroeconomic downturn in one of MELI's major markets, so a lot of the money that is currently spent on building the credit portfolio and also the infrastructure basically will be for nothing. And you would obviously have a massive slowdown in growth. So it's very difficult to model this out. I don't know if it's realistic at all, but let's just assume that top line growth slows down to low double digits. I went for 10% and margins stay flat at today's levels. Well, that might not sound that bearish, but considering the front-loaded investments right now, that basically means none of them pay off at all, and the money is more or less gone. So at that point, you got to say, okay, well, growth of like 10%, margins not looking that good. What is the multiple you would put on it? Probably 20 times. And then you would actually end up with a stock that is about $700. So do I think this is likely? Not at all. But is it possible? Sure. I mean, you never know what happens, especially in emerging markets. So I just want to say, do I think this is the most likely bear case out there? Probably not. But it's definitely a possibility that I at least want to model out to see, okay, where could this go if things go terribly wrong? And when I put it all together, I get an expected return from the current price of about 17%, which comfortably clears our 12% hurdle rate.
I've tracked MELI passively for over a year now, I think. And yeah, I mean, this is just one of those businesses that blows you away. And every time I talk about it or hear somebody talk about it, I just get more excited about it. It's truly best in class. And recently, Mr. Market has seemingly given us at least a decent entry price, as he's prone to sometimes do, especially with these fast growing emerging market companies. And so in terms of operational excellence or other Latin holding Nubank, I mean, that's pretty dang hard to beat. But I actually think MELI's business in a way is more durable. And I mean that literally in the sense that it's more diversified and its competitive advantages are more entrenched physically. Nubank has this digital infrastructure, cost advantages that are very legitimate, and they recycled that into benefits for customers. But that advantage is not carved into stone. It's not guaranteed to last forever. I think it's a very strong moat, but it's not impenetrable. And so hypothetically, I could imagine someone being able to at least build out a rivaling tech stack eventually that supports a financial app that could be just as trendy for some new reason. But when we're talking about a company like Mercado Libre that's anchored in this real world, massive logistics network that is very difficult to physically recreate, and then to have the same operational experience and excellence in running that network, right? You can't just build out a bunch of hubs and then from day one run them as efficiently as Mercado Libre does. Between those things, at some point, I think that it becomes very clear that this is a durable business with a lot of promising upside. And the only kind of caveat I would say is we are kind of now looking to bet largely on two of Latin America's best businesses, but that is a lot of exposure to a part of the world that has not been known for its historical stability whether that be militarily, politically, or also economically with, currency devaluations that we kind of mentioned before. Argentina is notorious for defaulting on its debt, and those do have real business implications. Rule of law and stability, that matters tremendously, and that's one of the things that has made the US such a special place to invest in. And on the flip side, that is what can make places like Latin America so challenging to invest in. When we have 20% of our cash in our portfolio waiting to be allocated for the most part, I don't mind having a chunk of exposure to Mercado Libre and Nubank at the same time. At some point down the road, if we're looking to add further to either of those positions, we probably want to almost balance them against each other, where we're saying, hey, if we're more optimistic about Mercado Libre and we want to bet more on it, then maybe we need to trim the Nubank position. Or it's not always the most effective framework to have that kind of binary thinking, but I kind of would suggest that we might consider that just so we don't get too carried away and have almost a reckless amount of portfolio exposure to a very volatile region of the world. And so I think I'd be comfortable. I know I'd be comfortable with a 3% bet, but I probably wouldn't flinch at even a 5% position size either. So I kind of say it's up to you whether we go 3 or 5%, so long as our combined Latin America exposure between the two companies remains below 10%, I would say. It's a part of the world I'm optimistic on, but not more than 10% of our portfolio exposure optimistic on.
And it's not only about the geography. You would basically bet on payment companies both times. You have Mercado Pago, which is a huge part of Mercado Libre, and you have Nubank, and both of them operating in the same countries, basically. Nubank is mostly in Brazil, but the same is true for Mercado Pago as well. So thinking about risk management, it's obviously about position sizing here, if we think about these two companies. So I also like to look at the range of outcomes. So when I said, okay, well, I have this very bearish case for Mercado Libre, then I would say I did that mostly to think, okay, well, how comfortable am I with putting money into this, considering the geography, considering we already have Nubank, and then considering that in these models, there will be a difference of about $2,500 between the bull case and the bear case of the company. And I'm pretty sure there'd be a similar difference for Nubank if you would model out all three cases. But I think it's safe to say that there's quite a wide range of outcomes. And I would totally agree that at some point you would need to think about how much exposure do you want to those markets. And Nubank has performed outstandingly well. So I think it's not that smart. And it's one of the learnings that we had in this year to let our winners actually go further and run, and not changing them out for companies that have either not yet performed for us or just didn't perform well in general. So if it's up to me, I would say we make it a 3% position, close to where Nubank is currently trading, or at least has been before it went up so much. And that would take our exposure to that market to about 7 or 8%. And if we make any changes to that decision, because we feel like this should be even more of our portfolio, you would know about it in our weekly newsletter that is free and that we send out every Sunday. We will send it out on MELI too. Actually, today, when you listen to this, it will be out, and it will also have the final decision on portfolio sizing in there.
Yeah, the newsletter is great we like to just keep the focus on covering a different company that's new each week on the podcast. But in the newsletter, we really take the chance to revisit previous decisions and kind of flesh those out more. But I think we're on the same page, Daniel. 3% seems like a reasonable place to start. And honestly, I hope that we get some more weakness in the stock and we can add to it. I wouldn't be surprised if this quickly became either because of the stock running up on its own or because of us doubling down on it, much bigger than a 3% position.
Totally. And honestly, we just had a talk in our community from a hedge fund manager in China. We also talked about how you should position yourself in certain companies that might be great, but they are in certain geographies in the world. And how you should look at it if, first of all, you don't have boots on the ground. And then second of all, from the regulatory standpoint of just being in another country, and maybe there are political tensions at some point as well. So all of that kind of in the back of my head would tell me, do 3% today and perhaps you boost it up to 5% at another time. All right, the episode is already quite long. So how about you give us the hints for next week's episode?
Next week will be a change of pace, that's for sure. Not nearly as sexy as Mercado Libre. We are going back to the world of sporting, looking at a trophy asset actually, but through a lens that we didn't really consider before when we covered Madison Square Garden sports and Manchester United. And so next week's pitch, like I said, is a sports company, but it's one that's found a way to make money that's even more profitable in a way than relying on TV viewership. And their viewership is also nothing to shy away from either. So the event they host is honestly a staple of American culture, even if it goes by in just 2 minutes. And all right, I'm already probably giving away too much.
It's interesting because you told me about it beforehand and you asked me if I would even know it. And I think if you're an international viewer here, you probably don't know what Shawn is talking about right now, but from everything I heard, if you're a US citizen, you probably already know what it will be about next week. All right, so then it's my job to close today's episode, and I will do so with a quote by none other than Mercado Libre founder and now former CEO Marcus Galperin. And he said, overspending early and not focusing on building a great product is the biggest mistake. And it's obvious he took that advice too hard when building Mercado Libre, and I'm sure his successor will too. And with that, I'm glad we have this company in our portfolio, and we will see you all next Sunday.
Thanks for listening to TIP. Follow the Intrinsic Value podcast on your favorite podcast app and visit theinvestorspodcast.com for show notes and educational resources. This podcast is for informational and entertainment purposes only and does not provide financial, investment, tax, or legal advice. The content is impersonal and does not consider your objectives, financial situation, or needs. Investing involves risk, including possible loss of principal, and past performance is not a guarantee of future results. Listeners should do their own research and consult a qualified professional before making any financial decisions. Nothing on this show is a recommendation or solicitation to buy or sell any security or other financial product. Hosts, guests, and the Investors Podcast Network may hold positions in securities discussed and may change those positions at any time without notice. References to any third-party products, services, or advertisers do not constitute endorsements, and the Investors Podcast Network is not responsible for any claims made by them. Copyright by the Investors Podcast Network. All rights reserved.
Coupang has, in short, captured the hearts and wallets of nearly every household in South Korea in less than 15 years. Partly that comes from succeeding so well in adjusting the Amazon online retailer model for the customs and preferences of South Koreans. Additionally, it helps that internet usage is so common in the country, with 97% of the population using the internet compared to just 78% in China. E-commerce is a natural part of life in South Korea's densely populated cities. Where e-commerce represents about half of all retail sales in South Korea, the number is only 16% in the US. So, like I said, e-commerce adoption in the country is just very, very high. Behind this vision is Bom Kim, who moved to the US as a child and later enrolled in Harvard's MBA program before deciding to chase something even more ambitious.